Welcome back, class. We're going to jump into this final segment of our chapter 9, and we're going to start off talking about, again, kind of the continuation of economic profit and economic losses. Uh, and one of the things that the authors talk about is, maximize short-run profits. Uh, you're also at the same time, trying to minimize short-run losses. So you've got firms that constantly are looking at it, and we'll go back to the farmer. Farmer is constantly looking at, short-run profits, short-run losses, and you want to maximize the I hate to say the good, but you want to maximize your profits, you want to minimize your losses. And economic profits will attract new firms. New firms' production will drive down the market price. So, again, bringing in new firms are going to drive down the market price, shrinking profit until they disappear. And if you think about how it happens, go back to the I can't remember which chapter it was, but the chapter where we talked about supply shifters, and number of firms are one of the supply shifters. So if you bring in more firms, they're going to be producing more output because you've got more firms in the market. That's going to kind of shift that supply curve out. And what happens when you shift the supply curve out? Prices kind of come down and quantity goes out. Depends on, the ultimate level will depend on what happens on demand, but we're talking about at this point just shifting that supply curve. And that's what happens when you bring new firms in. And at that point, it will shrink the profits until they disappear. Economic losses will cause some firms to exit the market. And again, firms exit, supply curve shifts up, price goes up until economic losses disappear. And the long run result of entry exit is an industry populated with producers who earn no profit. Kind of a strange situation. But that is the way that the economic losses, economic profits, firms come in. Remember, we're talking about a competitive market with easy entry and easy exit. So you've got firms floating in and out, and it's causing the supply curve, the market supply curve to shift, and it's impacting the prices, and it's going to determine where that level of profit is. Economics versus accounting concepts of profit losses. So again, I've never understood exactly. I mean, I do understand, but I guess it's always confusing to students when you're talking about economic concepts regarding profits and losses and accounting concepts regarding profits and losses. So explicit cost, charges that must be paid for factors of production such as labor and capital. Go back to your farmer. Farmer sits down with his accountant, January, February, getting ready to file taxes, and the accountant's, calculating and, looking at revenue, and they're looking at all the cost and the expenditures. And what the accountant is looking at is explicit cost when, filing taxes. So, and you're looking for explicit cost because you're looking at charges that have generated invoices. The invoices had to be paid, and so that becomes an explicit cost. So your accounting profit is, going to only use the explicit cost. And so profit from an accounting concept is going to be total revenue minus total explicit cost. Now, if you think about another cost that floats out there, it's implicit cost, a cost that is included in the economic concept of opportunity cost, but that is not an explicit cost. And you think about opportunity cost, and you've got, the farmers got, capital stock, they've got, some, grain elevator, they've got, machinery sheds. And the opportunity cost is what is the next best use of maybe that capital stock? And that's where the farmers should be looking at its opportunity cost. Not only that, could he make, could his family be in a better situation if he went and took a job working at a factory downtown, generating a steady income, turned around and leased his land to the neighboring farmer, leased his machinery to the neighboring farmer, and let the farmer worry about, generating profits, producing corn or soybean or wheat or whatever. And so that's where we're talking about these implicit costs. We're looking at opportunity costs, and that's, I don't want to say it's a proxy for opportunity cost, but it's in the same vein of looking at opportunity costs. So now you're going back, and now, so let's think about, you've got the accounting model, or the accounting formula that says profit equal to total revenue minus explicit cost. And you've got the economic, formula that says total, profit equals total revenue minus explicit cost minus implicit cost. And so you rearrange the terms, and the economic formula then becomes the accounting profit minus the implicit cost. And that is the difference between the accounting approach and the economic approach when it comes to calculating profits. And we'll get into that a little more as we kind of finish up this text. But sometimes just the concept of the implicit cost seems to throw students a little off base, but it shouldn't. It's a formula. You have the numbers, you plug them into the formula, and it generates a result. Eliminating economic profit and the role of entry. So as long as economic profits are positive, again, total revenue minus explicit cost minus implicit cost, if they are positive, entry will continue. An economic profit at all indicates that you are doing better than any other occupation. Remember, talking about when I talked about the farmer, going to work at the factory downtown. If you're generating any economic cost at all, you're generating a positive economic cost, because total revenue minus explicit cost minus implicit, which is I'll call it a proxy of opportunity cost, then that means that you are better off as a farmer than any other occupation. Increased in production from entry of firms is going to do what? If a market economy is generating economic profits, and other individuals or other firms see that it's generating economic profits, you're going to have firms, because easy entry and easy exit, firms are going to enter. And what's that going to do to the uppercase P, the market price? It's going to drive the market price down because the way the supply curve shifts. Long run equilibrium in the industry. And that is, now you're talking about the long run marginal cost equal to the long run average cost. Marginal cost always passes through the minimum average cost curve. Marginal cost equal long run marginal cost. All individual firms are maximizing profits. If uppercase P, the market price, equal the marginal cost, the outcome is efficient. If the capital uppercase P equals long run average cost, then uppercase P equals average cost, and economic profits are zero. Because economic profits equal to zero, what does that mean? It means there's no reason for firms either to enter the market, or there's no reason for firms to exit the market. remember, we're talking about an economic profit, not an accounting profit. Long run average cost is at a minimum produced using fewest possible scarce resources. So when the long run average cost is at its minimum, the firm is, producing using the fewest possible scarce resources. The uppercase P, or the market price, equals the minimum long run average price consumers buy for the lowest possible sustainable price. So you've got all of these factors working in the long run to drive the market to equilibrium. In a truly competitive industry, all possible profits are competed away. So if it is a truly competitive industry, you're going to have the profits competed away because of the ease of entry and exit. Consumers end up receiving the greatest possible quantity at the lowest sustainable price. So I'm a consumer, you're a consumer. It's great for us because we are receiving the greatest possible quantity at the lowest sustainable price. Eliminating losses eliminating these losses, that's the role of exit. So been talking about the role of entry and what it does to the supply curve and the market price and other aspects within the market economy. And now we're talking about the role of exit. Exit eliminates losses in the long run. And why does it eliminate losses? Exit, fewer producers, in theory, drives that supply curve backwards. Quantity goes down, price goes up. Economic losses indicate a better opportunity in another industry. And why does it indicate a better opportunity in another industry? Because of the implicit cost portion of the economic profits. Remember, economic profits equal the accounting profits, which is total revenue minus explicit cost. And economic profits, they also take that implicit cost piece out. And that is your opportunity cost, and that implies a better opportunity in another market industry. Firms exit, supply decreases, market price increases. Firms set marginal revenue equal to long run marginal cost. Fixed ideal, little q, lower case quantity, and then the market price equals the long run average price. Economic profits equal zero, exit ceases, and the long run equilibrium is reached. So long run equilibrium, if there's an economic profit, it's going to be reached as firms come in. If it's an economic loss, that long run equilibrium is going to be reached by firms exiting the market. Entry, exit, and production cost. And now they're going to spend just a few minutes talking about some industry cost. And it's interesting the way they put this together, and we'll walk through it together. A constant cost industry. So they go through some definitions first. Industry in which expansion does not affect the price of factors of production. Interesting. Increasing cost industry. Industry in which the entry of new firm bids up the prices of factors of production. And that makes sense. In a increasing cost industry, you are bringing in new firms. New firms are going to generate output. And to generate output, they have to have factors of production. So it bids up the prices of the factors of production and thus increases the production costs for all of the firms. It increases the average cost and it drives equilibrium at a higher minimum. Long run average cost when the industry was relatively small. It increases the market price to cover the increased cost in the long run. So to cover your cost, you're going to have an increase in market price. and the long run supply curve, it's going to be upward sloping. And when you um, increasing cost of industry, think about healthcare. Just I guess 2 weeks ago, Kaiser, individuals talking about, striking on Kaiser. Think about United Auto Workers. They're still in a strike. I guess they're close to having something worked out with Ford. But, what do you think that's going to do with the cost of production? If you settle with the union, it's going to raise the price of labor. And if you raise the price of labor, it's going to raise the price of the factors of production, which is going to raise the cost of producing. Think about tech firms. Tech firms are constantly, especially, you see on the internet some of these salaries that they're willing to pay individuals that are kind of at the top of their game in this artificial intelligence industry. And, they're throwing numbers, like $1 million a year around as a salary. And, just envision what's going to happen in the tech industry is with those factors of production that it's going to, you've got new firms coming in, and all of a sudden it's significantly increasing the factors of production of all the firms that are there. And then they talk about the constant cost, they talk about the increasing cost industry, and now they're going to spend a few minutes talking about the long run industry supply curve. It's a curve that relates the price of a good or service to the quantity produced after all long run adjustments to a price change have been completed. And so they go through some examples in the text, and they're talking about that long run supply curve, and then they spend a few minutes talking about a decreasing cost industry in which production costs fall in the long run as firms enter. We talked about economies of scale in one of the earlier chapters. Economies of scale technologically advances, lower input cost and long-run equilibrium prices fall as output expands. Long-run industry supply curve at that point does what? I mean, think about what I just said. Economies of scale, technology advances, lower input cost at a long run, market prices fall as output expands, and long run industry supply curve slopes downward. And what have we talked about in one of the earlier chapters about a decreasing cost industry? Think about the chapter that we started out talking about: computers, oil and gas, stock market. Decreasing cost industry, it fits computers perfectly. Cost has come down, quantity has increased, and it's been a boon for the consuming population. So computers are a decreasing cost industry. Zero economic profits drive the markets. Changes in demand, and we're going to talk for a few minutes about changes in demand and in production cost. Profit maximization plus market conditions drive the long run equilibrium in competitive market. So we're still in the long run, and we're talking about profit maximization of firms in the long run, coupled with market conditions, are going to drive that long run equilibrium of prices and quantities. And we're going to bounce back to see what happens when market conditions change. And we're going to stop for a few minutes and talk about the constant cost industry. We're going to hit it first and talk about how market conditions impact it. So, you talk about a constant cost industry. Now you're talking about changes in demand. And what were our demand shifters? Think about, I can't remember which chapter it was, maybe 5 or 4 or 5. We talked about preferences and information. We talked about prices of related goods and services, talked about income, demographic characteristics, buyer expectations, those are all demand shifters. Consumers want more of a good. I mean, again, it goes back to more is preferred to less. It could be, more costly to produce, more costly to purchase. Again, demand shifters. In the short run, consumers bid up the prices. In the short run, profits brought in more firms. New firms drive the long run average cost down, and price reverts to its original price in a greater quantity. So again, you've got these dynamics in the marketplace, and you have changes in conditions in the market. There are factors that impact the changes that are, respond to the changes in the market. And after the market forces do their thing, again, Adam Smith's invisible hand, then we end up with the price going back to the original price at a greater quantity. A decrease in demand will cause a reversal of these steps. So there was an increase in demand, and you went through a set of steps that you ended up with back to the original price in a greater commodity or a greater quantity. And if there's a decrease in demand, you're going to end up with just the reversal of those steps. Now, we want to talk about changes in production cost. In a change in cost of inputs, a change in technology driving production processes. So remember, technology is driving the production processes. Production costs are coming, if they come down, and the long run marginal cost, long run average cost comes down, then you're generating an increase in the lowercase quantity, in the quantity of the firm. Prices fall less than cost initially. Firms earning economic profits because the market price, the uppercase price, is greater than the long run average cost. And that's long run average cost, and they have a little subscript 2 times the lowercase quantity of the subscript 2. And so now all of a sudden you've got more firms enter and compete away the economic profits. Remember, we talked earlier about when you have economic profits, we have more firms coming in and they compete them away. If you have economic losses, you have firms exiting the market. So you're talking about, in the short run interactions, price falls to the long run equilibrium and the quantity reaches the long run equilibrium. And, and you can actually reverse the process, and it backtracks, and you get just the reversal of the answers that we've just gone through. So whether you're, talking about, supply and demand moving one way or the other, once it moves one way, you can have a shift in the other direction, and it just reverses the process. So again, if you can think through it in one direction, then it's fairly straightforward to reverse the process and go back in the other direction. That's going to wind it up with this one, with competitive markets. When we get, next time you see me, it's going to be chapter 10, and we're going to be talking about monopolies. Until then, thanks for joining, and it won't be too much longer till we'll get back together again. Talk to you later.